Welcome back. Today we're tackling the biggest investing mistakes that could cost you thousands. Mistakes even experienced investors make. The market's always changing, and what worked last year might not work in 2025. My goal? To give you a no-nonsense guide to avoid rookie errors and build a resilient portfolio. We'll break down 7 critical mistakes, why they're dangerous, and what to do instead. By the end, you'll have a clear roadmap to protect your capital and optimize your returns. Let's dive in. Let's discuss common investment pitfalls that can impact your financial future. We'll break down these errors, explain their dangers, and show you how to avoid them. Mistake number 1, failing to diversify. This is like putting all your eggs in one basket. Putting all your money into one stock or crypto might seem exciting, with the potential for massive gains and the fear of missing out. But it's like walking a tightrope without a safety net. The allure of quick riches can blind you to the inherent risks. If that single investment tanks and history tells us that even the hottest investments eventually cool down, so does your net worth. You're potentially wiping out a significant chunk of your savings, derailing your financial goals. Diversification means spreading your money across different assets like stocks, bonds, and real estate to weather different economic conditions. It also means diversifying across industries and countries. Don't limit yourself to one sector or region. Don't just buy tech stocks. Even if you believe in the long-term potential of technology, add healthcare, consumer goods, bonds, and other asset classes to create a more balanced portfolio. When one area drops, as inevitably some areas will, another might hold steady or rise, offsetting the losses. You don't need a fortune to diversify. In fact, it's even more critical when starting out with limited capital. Index funds and ETFs let you own hundreds of companies with one investment, providing instant diversification at a low cost. An S&P 500 index fund tracks the performance of the 500 largest publicly traded companies in the United States. Consider international funds and bonds for stability. Investing in global markets can reduce your reliance on the U.S. economy. Diversification won't guarantee profits or eliminate losses, but it protects you from catastrophic losses by mitigating the impact of any single investment going sour. Review your portfolio. Are you all in on one bet? Assess your level of diversification. If so, it's time to spread out and build a more resilient portfolio. Building wealth is a marathon, not a sprint. It requires patience and a long-term perspective. Diversify, stay steady, and you'll go the distance. Mistake number 2, a common pitfall for many investors trying to time the market. It's a seductive idea, promising quick riches, but it's fraught with peril. Many are lured by the prospect of predicting market movements, but is it truly possible? The fantasy, the alluring dream that captivates so many? Sell at the absolute top, buy at the very bottom, and get rich beyond your wildest dreams. It sounds simple, doesn't it? A foolproof plan for amassing wealth, reality, a stark contrast to the fantasy. Even seasoned Wall Street pros with all their resources and expertise can't do it consistently. They have access to sophisticated tools and vast amounts of data, yet they still struggle to accurately predict market fluctuations. You have to be right twice, a double dose of perfect prediction. First, when to sell, anticipating the market's peak with uncanny accuracy. And then, when to buy back in, catching the absolute bottom before the market rebounds, a feat of incredible precision. Miss either one, and you lose out on potential gains. The market might surge while you're on the sidelines, diminishing your returns, or buy back in too late after the initial surge, missing the most significant part of the recovery. The market's best days often follow its worst, creating a volatile landscape for would-be timers. And missing just a few of those best days can wreck your returns, significantly impacting your long-term financial goals. The stress of constantly guessing the right moment, the endless monitoring and second-guessing, leads to emotional, often costly decisions, driven by fear and greed rather than sound financial principles. The solution, a more rational and effective approach. Time the market consistently beats the market sporadically. A long-term perspective is key. Use dollar-cost averaging, a strategy that takes the guesswork out of investing. Invest a set amount regularly, regardless of market conditions. Set it and almost forget it. No matter what the market's doing, whether it's soaring or plummeting, stick to your schedule. This way, you automatically buy more shares when prices are low, essentially getting them on sale. And you buy less when they're high, preventing you from overpaying during market peaks. Ultimately lowering your average cost per share over time, smoothing out the impact of market volatility. automate your investments to further remove the emotional element, and ignore the constant market noise, the daily headlines and expert opinions that can lead to impulsive decisions. It's not flashy or exciting, but it works consistently over the long haul. So, in 2025, skip the market wizardry, the attempts to predict the unpredictable. Instead, stick to a disciplined, well-thought-out long-term investment plan. That's how real, sustainable wealth is built, not through fleeting moments of market timing. Mistake 3. Ignoring fees and expenses. A 1% fee might sound tiny, but over decades it can cost you hundreds of thousands. Every dollar lost to fees is a dollar that can't compound for your future. Actively managed funds often charge high fees and rarely beat the market after costs. Instead, look for low-cost index funds and ETFs. Vanguard, Fidelity, and Schwab are great places to start. Always check the expense ratio before investing. Watch out for hidden costs, account fees, trading commissions, advisory fees. The less you pay, the more you keep. Make it a habit to read the fine print and compare options. Don't let small leaks drain your portfolio. Minimizing fees is one of the easiest ways to boost your returns. You control this, so take charge. In 2025, be a fee detective. Keep more of your money working for you. That's how you grow wealth faster. Mistake number 4. Letting emotions drive your investing. This is a destructive habit, turning sound strategies into impulsive gambles. Fear and greed are powerful forces that amplify in the market, pushing prices to extremes. They make us buy high and sell low, the antithesis of successful investing. We get caught up in rising prices, then panic when the market corrects. Greed lures investors into speculative bubbles. You chase hype and FOMO, often at the top, investing in assets you don't understand at inflated prices. Fear takes over during crashes when your portfolio value evaporates. This leads to panic selling at the worst time, locking in losses and missing the recovery. The best investors stay rational. They understand market volatility and don't let emotions dictate decisions. Warren Buffett says, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian approach requires discipline and patience. The solution? Have a written investment plan, your personal rulebook. Set your goals, risk tolerance, and asset allocation in advance. When markets get crazy, stick to your plan. Automate your investments, so you're consistently investing. This removes the temptation to react emotionally. Limit your exposure to financial news. Check your portfolio only occasionally. Tune out the noise and focus on your long-term goals. Trust your process and let your plan guide you. There will be hype and new technologies, and panic. Your job is to stay steady, stick to your strategy. Build your plan, automate, set it and forget it. Embrace being boring. Boring builds wealth. Don't let emotions sabotage your future. Mistake 5. Neglecting your own research. It's tempting to follow hot tips from friends or social media, but that's gambling, not investing. If you don't know why you own something, you'll panic when it drops. True investing means understanding what you're buying, how the company makes money, its risks, and its financial health. If that sounds like too much work, stick to index funds or ETFs. They spread your risk and don't require you to pick winners. Never invest in something you don't understand. If you pick stocks, do your homework. If not, keep it simple and diversified. Don't risk your future on someone else's opinion. In 2025, be an investor, not a follower. Do the work or keep it simple. Mistake 6. Overlooking risk management. Many focus on potential gains and ignore the risks, until it's too late. Managing risk is what separates investors from gamblers. Know your risk tolerance. How much volatility can you handle without losing sleep? Set your asset allocation accordingly. Use stop-loss orders if you're an active trader to limit losses. Avoid leverage. Borrowing to invest can wipe you out fast. Don't let any single investment dominate your portfolio. Keep position sizes reasonable. Diversification is your best risk management tool. Spread your investments across assets, industries, and geographies. Always have a plan for when things go wrong. Protecting your downside is the secret to long-term success. In 2025, focus as much on risk as on reward. Build a resilient portfolio that can weather any storm. That's how you stay in the game. Mistake 7. Investing without clear goals. If you don't know what you're aiming for, you can't build the right strategy. Your goals, retirement, a house, college, should shape your investments. Short-term goals need safety and liquidity. Long-term goals can handle more risk for higher returns. Write down your goals, what you want, how much you need, and your timeline. Use these specifics to guide every investment decision. A clear goal turns vague dreams into actionable plans. It keeps you focused and motivated even when markets get rough. Don't just say, "I want to be rich." Define what that means for you. Align your investments with your timeline and values. In 2025, invest with purpose, not just hope. Your goals are your foundation. Build on them for lasting wealth. There you have it, the 7 critical investing mistakes to avoid in 2025. Diversify, avoid market timing, minimize fees, control your emotions, do your research, manage risk, and set clear goals. Build a low-cost, diversified portfolio aligned with your goals and stick to a disciplined plan. Replace gambling with strategy, emotion with logic, and anxiety with confidence. This is how real wealth is built, step by step, for anyone. If you found this helpful, subscribe for more practical investing advice. Thanks for watching. Now go invest smarter and avoid those traps.